This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. My guest on the show today is Artem Fokin, portfolio manager at Caro-Kann Capital. Even though I just had Artem on the pod for the live podcast panel we did at the Planet MicroCap Showcase Vegas, his answer to one of the questions about what his most controversial microcap investing opinion is right now inspired today's invitation back on. Tune in to hear what Artem's answer is, and then we dissect what his hypothesis could mean for the microcap investing environment. Thank you again for tuning into the Planet MicroCap Podcast, and please enjoy my conversation with Artem Fokin. Artem, thank you for joining me today. How you doing, man?
Thank you for having me here again virtually after seeing you in Vegas just about a month and 12 days ago.
Yeah, long time no see, right? Listen, I'm finally fully recovered. You know, it was a gauntlet to say the least, but here we are. You know, we're back at it. But I mean, look, for those that obviously who are fans of the podcast and listen to every single episode, like I know everybody does, right? You know, especially, you know, anyways. But you know, Artem was just on the podcast for our live show that we did in Vegas. And I invited him back on because you probably heard, if you did listen to that, where I was like, oh, you just said something that we need to dive further into. And it was when I asked the question to all the panelists, which I got to give kudos to Michael Liu because he actually was the one that came up with the question. But I was the mouthpiece. And the question was, what is your most controversial investing opinion right now? And everybody actually had great answers, but Artem's was by far the most controversial, to say the least. And so I wanted to dive deeper into that and what he said and really exploring the idea here. So for those that didn't see the interview or see the panel, Artem, you know, what did you say on that panel? You know, what is your most controversial investing opinion right now?
Okay, so that's exactly what happened. So I confirm everything that what Bobby said. And I also want to give Bobby and his team a big shout out for putting an excellent conference in Las Vegas about 1.5 months ago. There were a lot of companies. I had a lot of meetings and attended a lot of group presentations. I think it was incredibly productive time. So I would, number one, thank you for putting such a great event together. Number two,
Thank you.
I would encourage anybody who is interested in microcaps, or if you're a management team of a microcap company and you haven't attended Bobby's conference yet, which probably unlikely, but maybe there are a couple of companies in the US or Canada who haven't done that. But jokes aside, please consider coming. I think it was excellent. And I think both investors and companies enjoyed the event.
Thank you.
So with that, what Bobby described about the panel is true. There was a question, what's your most controversial investment opinion, ideally in the microcap space land, that you hold? And my answer to that was the following. For the last 18 months or so, I've been hearing from many investment practitioners in the microcap and small cap land, as well as from capital allocators. And by the way, some of those opinions were even said during the conference, that the microcaps and small caps have underperformed large caps and mega caps by a big margin for an extended period of time. And if people look at historical data series, that underperformance seems to be unusual. Some people may even use the term abnormal. Therefore, people get to the conclusion there will be a rebound, and microcaps and small caps would go probably through a period of substantial outperformance versus large caps. Based on my observations, this is somewhat consensus/conventional wisdom. And my opinion that I expressed on the panel, which was done live, was that I don't share that view. And the reason why I don't share that view, and I had only a few minutes to elaborate on the reasons, and that's why Bobby said that's a fascinating topic, let's get on a pod and do it separately. And the reason why I don't believe that is not because the historical series is wrong, but because the structure of the US economy and the structure of public companies, of the structure of the public markets, of the equity markets, and the way companies go public and when they go public have undergone such tremendous changes over the last 15, maybe 20 years, that extrapolating that historical data series doesn't, in my opinion, does not have a very high predictive power of what will happen in the future. So that was a high-level summary of what I said on the panel. So let me pause here. So Bobby, and you can take into any direction from here where you would like to take, because there are a lot of elements there.
Oh, tons of different elements. And again, this is why I wanted to have you on here to kind of dive into this. And just so that we're clear too, before we continue further, this is all based on Artem's observations. We don't have any data that's necessarily backing up some of these things. This is an interesting conversation because I tend to agree, especially because there's a lot of structural changes in the last, let's say 20-ish years. That has been making it more difficult for companies, not just to go public, but more importantly, to stay public, especially as a smaller company. But in your opinion, Artem, what have been some of those structural changes that you think would result in, let's say we were to create that data set, extrapolating underperformance for the small microcaps? What would you say are some of those changes that have happened that has resulted in some of the observations you made?
Okay, excellent. So I would underscore what Bobby just said. I'm not an academic researcher. I'm an investment practitioner. I run Caro-Kann Capital, which is a hedge fund. I'm spending my time meeting with management, modeling, doing expert calls, reading filings, doing field research. I am not running historical data series. I'm not an academic researcher. There are papers out there that show that over the last 30, 40, 50 years, small caps, microcaps tend to outperform big caps. However, what I'm saying about opinions for the future, this is not based on academic work. And if someone knows about academic papers or researchers who actually do that, please reach out to Bobby, please reach out to me, post on the comments, show those references. Because
call us idiots, please, by all means.
Yes, and if those research papers confirm my view, fantastic. And if they actually disprove my view, even better, because I would learn something and I will abandon a hypothesis that may be incorrect. Okay, so with those caveats, let's set the stage. I think there are two big changes in the structure of the economy and public markets that are relevant for microcaps and small caps. Number one, companies tend to go public substantially late in their life cycle. It's not uncommon for private companies to raise not just series A, B, and C, but hey, there are 26 letters in the English alphabet. And if you use Chinese alphabet, then there are probably a few 100,000 characters there. But jokes aside, companies raise A, B, C, D, E, F, and they keep going. I think SpaceX, I've read somewhere, raised series K or M. Now, it's an exception. But you see my point. Companies stay private a lot longer. That's number one. Number two, US large caps and mega caps have become substantially more innovative over the last 15, 20 years compared to where their predecessors were 30, 40, 50 years ago. And remember, that historical series that shows outperformance of microcaps and small caps have been collected at the time when companies went public earlier. And in my opinion, US big companies were less innovative. Now, why those are important? Two considerations, why they're important and why they play a role for potential returns in microcaps and small caps. So number one, the best returns in public markets, historically, there are many ways to generate returns, but one of them has been invest in companies that successfully bring disruptive innovation to the marketplace. They create value by creating consumer surplus and by capturing that surplus. What happens if you invest in those companies early in their life cycle, you're more likely to capture those outsized returns. If companies go public later, you're less likely to capture those because it will be private investors who invest in series D, E, F, G, H, whatever, capture those. And that change, I think, started probably around 2010, 2011, when Facebook, which is now Meta, no position, just mentioning that as an example, raised a substantial private round in private markets at high valuation. And that was probably a watershed moment in many ways when companies realized they don't need to go public as early as they used to. And this is probably bad for people like you and me, Bobby, because we have fewer microcaps and small caps to choose from. So that's first component. And before I go into large cap components and why that's important, please feel free to follow up either about disruptive innovation versus incremental, why it's important for return generation and outperformance.
Well, I appreciate that because I think that was actually one of in your quick 2-3 minutes when we did the panel in Vegas, that was one of your main points as to why you think that because of these structural changes, and I forget what book I literally was just reading it in, where the author signaled this change, and it's been pretty significant in the fact that some of these larger mega caps are focusing on innovation versus and why, as a result, there's been more of these companies just waiting to go public either later in their life cycle. It's almost kind of been like a last resort in some respects, or because they'll just stay private long enough so that they can get the highest valuation, so that some of these mega large caps, once they realize that, hey, it's easier for us to just buy this versus spending, X amount of dollars to innovate whatever they're already developed, right? So it coincides, I think, with another structural change, which happens to be just that it is very expensive, especially in the US, to go public, right? So a lot of these companies that are, maybe they would go public in the sub 100 million market cap range, they're kind of asking themselves like, okay, is it worth it at this point? So I don't know if that.
I think costs of being public have definitely increased since post-Enron world and after Sarbanes-Oxley. There are no doubts about that, and compliance has been getting more stringent. That's true. I don't believe that those costs are that substantial for type of companies I'm talking about. I'm talking about something like Airbnb. Once Airbnb, and by the way, Airbnb, no position, even though I did use their service and hope to use their service in the future.
Me too.
But no investment. So if you pick Airbnb, at the time when they went public, they could have gone public earlier. And for them, paying those several $1 million on compliance, public audit, etc., probably would have been fine. Remember, when those private companies get to a certain scale, many of them are being run inside almost as they was a public company, because their shareholder base will become quite substantial. They've gone beyond two VC firms that put money in early on. They could get dozens of investors. And by the way, some of them will be what people call crossover investors, like Tiger Cubs of the world, or even sometimes Fidelity or T. Rowe Price. You will see sometimes them in those Series F or Series G rounds. So I don't think costs play a role for those. For smaller companies, definitely, it plays a role. If you're speaking about sub 100 million, definitely, even sub couple of 100 million. But I'm talking more about companies going public, not a $500 million valuation or $1 billion valuation, waiting until they get 10, 20, 30 billion valuation.
Right.
I'm talking more about that phenomenon. And at that stage, with those numbers and their scale, extra few $1 million on compliance cost and public company cost, probably manageable.
Right. So I guess my one pushback just overall to the thesis or just to start right now, is, I mean, there's still a huge opportunity set just in North America, right? You still have what, 10,000 plus public small microcap companies in existence right now. Just looking, if we were to use all the Canadian exchanges, all the US exchanges, so even if, let's say, there's continued underperformance right now, I mean, it really just feels like more that the rebound isn't going to be the same as maybe other rebounds were, right? Because that's really what it feels like this thesis is derived, or this hypothesis is derived from. Is that where you're really coming from? Because of, when we think about interest rates and the greater economy and how we're more or less in a normalized interest rate environment where, okay, it'll maybe go down, quarter of a percentage point, quarter of a base point, whatever it is, it seems like that is more of where you're coming from with this versus when we were been in this 0 to very low interest rate environment for the last 10, 11, 12 years. Any of that makes sense?
Bring this up because it gives me opportunity to clarify something.
Okay.
When I say that I don't share a belief that microcaps and small caps will outperform, I'm talking about next 6 months or a year, or even 2 years. They could outperform, right? There are many factors there. Sure. I am trying to analyze them. I'm talking more about the structural change. If we look in the next 5 years or 10 years, will microcaps and small caps, and the reason why I'm bringing two together, because most research I've seen historical more focused on small caps as opposed to microcaps alone. So that's why I'm mentioning both categories. I think if we look in the next 10 years and we measure those, and by the way, Bobby, so today is June 12th, 2024. So if you could send me a calendar invite for June 12th, 2034, we'll do another pod and we'll check how that hypothesis played out, whether it was right or wrong. I don't think that when we go next 5, 7, 10 years, we will see the same outperformance of small cap and microcaps as we've seen historically. I'm talking more about that longer term horizon as opposed next year. Like, think about it. Before Walmart went public relatively early. I'm sure there will be Walmart enthusiasts, and by the way, no opposition, who know the history of the company better than I do, but it probably went public when it had, 30, 40, 50 stores? Think about when Apple computers went public, relatively early on. Think about Microsoft, relatively early on. And now compare that with Airbnb. Again, no position either in Microsoft or Apple or Airbnb, as I mentioned earlier, or Walmart for that matter. That's just a lot later. And this is the early stages of disruptive innovation when that massive value creation happens and investors could capture that. You and I, as public market investors, effectively deprived from those opportunities right now, or rather they become smaller. So that's a problem.
So maybe the pushback could be is cyclicality of right where maybe, and I've been starting to see it myself a little bit. I mean, is that, some of that private capital maybe dries up. Now they're like, what, we'll wait for this company to mature. And so now some of these companies are quote unquote forced to go public a little bit earlier than they normally would so that they can access capital markets and can access private capital in another way, or how it's traditionally been, let's say back in the 90s or in the 80s, or even in the early 2000s, or they're going to other markets to go public that are more, let's say, small microcap friendly, like in Canada or Australia, or some of the stuff they were seeing in Europe. What do you think about that?
I don't believe it's cyclical. I think it's secular. There will be fluctuations along the way, but it will be cyclical within secular. I don't expect we will witness a drop in fundraising in private equity, growth equity. I'm not talking about leveraged buyouts right now. I don't think we will witness a significant drop in the AUM within those private equity growth strategies or late stage VC. I don't think so.
Agree. I totally agree there.
And remember, as we spoke with you about, a number of public market investors expanded into crossover. Because in many ways, if you think fundamentally of a job of fundamental analyst, find businesses that would grow intrinsic value per share. Nobody has said that it should be done in public markets or private markets. In a way, this distinction is somewhat superficial and driven by regulatory and legal considerations, liquidity constraints, etc. But fundamentally, it's the same. So where that value creation happens, it doesn't really matter. And by the way, I'm not saying that there are no interesting microcaps to invest in. I'm just saying that the number of those interesting microcaps today is probably lower than it would have been if such a developed growth equity industry in private markets did not exist. That's my point. And that's why I think extrapolating historical returns of microcaps and small caps into the future is probably flawed because the premises have changed. And this is what I call disruption or challenge from the bottom. There's also a challenge from the top, which I mentioned, but we haven't got to yet. But hey, we have another 30 or 40 minutes or an hour.
Oh, 100%. I mean, now as you're saying things, I'm thinking to myself, okay, let's say your hypothesis does play out. In 10 years from now, the data shows out that, maybe there's still outperformance, but it's not as significant as, let's say, we were to, we're doing the data today. That almost makes in my opinion, that makes what any buy-side manager or any investing practitioner do even that much more important on the, especially if you're more on the individual stock picking side of things, right? Rather than just, coffee can portfolio, that kind of stuff. Because now it's like, all right, you can continue to, you can go into some of these large caps, you'll see maybe smaller, lower performance, or I guess it would be a different type of, I just don't know how you would measure that strategy, or how you would, what I'm saying? Do you see where I'm going with this? Maybe my brain.
I think what you're saying, Bobby, and what you're asking is that, okay, Artem, let's say your hypothesis holds true,
Sure.
And we'll find out in the next years whether it's true or not. What does it mean? What does it mean for investors in microcaps? What does it mean for portfolio managers like you who work in that space? Is it fair reframing?
Much more succinctly, and I feel like I should just hand over hosting duties to you at this point.
Look, anytime you want to go to vacation, just ping me. I'll jump in and help you out.
Beautiful. Go.
So I think what it means is that the tailwind that may have existed for some period of time when those studies were done that showed outperformance of small caps and microcaps, that tailwind may be gone. And it means that you cannot count on that anymore. Just because you invest in something smaller, it doesn't mean that you will capture an extra return. It means that, yes, being a good stock picker in microcap or small cap land becomes even more important. That would be very fair to say.
I mean, that's where I was going with it, is that whether the hypothesis plays out or not, it just continues to feed the point that, like, all right, if I'm going to be an investment practitioner, it just continues to prove the point, because there's always going to be individual stocks that, significantly outperform everything, or you happen to, 1 out of the 5 ends up making your whole career. And that's still of huge value.
In my opinion, there still will be what I call 6 Sigma stocks, referring to the distribution, where it will be really extreme outcomes for very few selected microcaps and small cap companies that would be able to create tremendous value for their customers, capture that value, and as a result, create value for shareholders.
I mean, at the end of the day, it would just really come down to how are you going to gamify or game the system so that you figure out how you're now going to market yourself in order to generate more fund flows, right? No matter what the performance ends up being. at the end of the day.
Fund flows in terms of flows of investment funds in various pockets of the markets.
Exactly.
Okay, let's bookmark that. Let's save that for a little bit later, because on fund flows, it's something that I find interesting, and I may or may not have another controversial opinion on that issue.
Oh, beautiful. Okay. Why not go there now? I mean, honestly, like at the end of the day, in challenging this, I mean, obviously, we'll have to see in 10 years if that ends up being true. I know just from talking from many of these different service providers out there that there is a lot of conversation of how to make things more friendly for some of these companies to go public earlier in their life cycles, so that we're not just waiting until they're 10, 30, 40 billion market caps to
I don't think it's a problem. I don't think you can solve that.
No.
Think about it this way. So there are many ways for staying private longer. It's incredibly difficult for any human being to be long-term focused. Whether we're talking about small things such as skipping that dessert at dinner because it's very nice short-term, but it's probably not good for your health long-term. Or we talk about portfolio managers of funds. It's difficult when you have monthly or quarterly performance reports. And it's similarly difficult for executives of public companies with their quarterly reporting, and many investors are short-term focused. It's a lot easier to be a long-term focused when you're private. So there are advantages of being private. And think about how much time CEOs and CFOs spend on investor relations once they go public. And that time is taken away from working with your internal team on marketing or product or design or innovation, or talking to customers or doing sales or doing whatever you need to be doing. So staying private has advantages. So I don't think, sorry. What I'm saying, Bobby, I don't believe if the US Congress comes up with a reform and says, we're massively reducing requirements to go public, I don't think those very high quality companies would say, great, we're skipping round F, we're going public. I don't think it will happen. What you are saying, what it may lead to, however, it's possible that other companies that for whatever reason cannot raise money privately may find it easier to go public, which will create some challenges because some of those companies probably should not be public. But some teams that are very well deserving may get easier access to capital markets that may help them build something. And that would, by the way, would be more relevant for regions, whether it's within the United States or outside of the United States, that have less developed venture and growth equity ecosystems.
I mean, at the end of the day, we're mostly talking about companies that are likely revenue generating, maybe even profitable.
To be clear, I'm talking also important. Yeah. I'm talking only about companies that are revenue generating. I'm not talking about biotechs that are pre-revenue. I'm not talking about some technology company in some, moonshot or some new battery technology that goes public or private or stays private, but their revenue will be 5 years later, right? I'm not talking about those. I'm talking about companies that are analyzable by a, call it in quotes, traditional equity investor, traditional business and fundamental analyst that has revenue, that has certain fixed cost versus variable cost structure, has marketing, has general administrative expenses. You can analyze margins, you can analyze incrementals, you can analyze unit economics.
Absolutely. And, look, I definitely agree with you to an extent there. I think it just also depends on, that the market environments as well. And whether, I don't know. Again, I think that some of the biggest winners recently, especially when I look at my index, that, every single quarter, what sector outperforms everything is healthcare, right? and biotechs, because there's always about 10 to 20 or 10 to 25 winners that are up. And no, this is not split adjusted or not adjusting for splits or anything like that, that are up, 2, 3, 400% because they finally got, some incredibly quality data, or got acquired, or just went commercial, something like that. So I do think that, despite the fact that, yes, on the revenue generating side, some of those private companies, they can wait a little bit longer in their life cycles to go public. There are still some of them, that are going to be going public in order to, let's say, do some acquisitions that they just need to go public in order to raise that growth capital in order to do those acquisitions. But at the end of the day, I think, especially in the small microcap space, there are going to be a lot of those moonshots that will continue to go to capital markets in order to, one, access that growth capital, now have public equity so that they can continue to raise capital because they'll need to. And I don't know. I think that'll always be there.
What you're saying is super interesting, Bobby, because I must make a confession. I am not checking my Planet MicroCap Index too often. Now I need to start doing that. You can check on me next time when we talk on the podcast, or even privately offline. So, but what you shared with me about your observations about what generates strong returns, and you mentioned biotech and healthcare, this is super interesting for this reason. I'm not a biotech specialist, but this is my observations. Biotech companies, for whatever reasons, tend to go public still fairly early compared to, let's say, software companies, soft or tech companies in general. Those software companies, SaaS companies, tend to stay private a lot longer than biotechs. So what you are saying, in a way, gives me another interesting data point to fit into my hypothesis that biotechs do well in microcap space because there are more of them going public early, and some of them will be successful. Some of course, will not succeed.
I mean, also there might be a little bit of a and I'll say this too. There might be also a little bit of a recency bias right now, because biotechs they were getting killed, absolutely killed. And I'm not saying that there's been like a massive rebound in biotechs or anything like that, but I know quite a few buy side investors that are looking at picking up a basket of biotechs just because it's been so hated, and there's no way that all of these companies are complete dogs. There's some event-driven stuff within some of these biotechs. They're just waiting on that data. So there's just more opportunity than there has been recently, especially in biotech and healthcare, than there was in the last 2 to 3 years. But again, just giving you more info.
Got it.
Yeah.
So we spoke with you about what I call disruption from the bottom, meaning companies stay private a lot longer and go public later in life. But there is a second piece there. A lot of disruptive innovation moved inside very large companies. And I think this is different from the way it was, let's say, 40 or 50 years ago. This is what I mean. Look, for example, at Amazon, no position. AWS was effectively an internally created startup within an online retailer that has become an incredibly valuable business. Look, for example, at no position and Amazon. I mentioned. Yeah. So that no position. Okay. Look, for example, at Meta or Facebook. Again, no position there. Meta acquired Instagram, I believe in 2012, if I'm not mistaken, for about $1 billion.
Yes.
So they didn't build it, they didn't invent it, but they bought it very early on. Look at what happened now. It's a massive business within Meta. Make a comparison here with News Corp, no position in News Corp either, that bought MySpace. Do you have an account at MySpace, Bobby?
Oh, I used to.
Okay, but not anymore. That's my point.
I don't know.
As far as I remember, they bought News Corp bought it in 2007, and that didn't paid pretty big amount of money.
Yeah, it's like 600 million, I think.
I think something like this.
Yeah.
And as you can see, it didn't go too well. MySpace was effectively, it's not relevant anymore. Whether it was the business was doomed from the beginning or whether ownership under News Corp was the kiss of death, I don't know. But my point is to contrast how innovation happens within big companies, very big companies, now versus before. This is very different. And historically, I think if you make parallels, 30, 40, 50 years ago, AWS would not have been created within Amazon. It would have been done privately. And then it would have gone public at some point relatively early on in life. See my first premise. That's a very, very big change. Bigger companies just more innovative today than they used to. And part of the reason, I think, is because most of them came from venture-backed background. If you look at the biggest US companies, most of them were backed by venture capital. And many of those companies still retain that culture, the DNA of innovation and entrepreneurship, even if they got very, very big. And I think it's a big change in corporate America versus 40, 50, 60 years ago, if you look at whatever big companies were back then. It's just different. And again, this is not good for small cap and micro cap investors. This is a hypothetical example. Whoever came up with an idea of AWS or something else, pick an example. I'm using just Amazon and AWS because everybody knows about them. It's easier to relate. The person who came up with the similar idea 30 or 50 years ago or 60 years ago would have not been understood and accepted within the company, probably would not get a chance to execute on that, eventually would get unhappy, leave, raise a little bit of money privately, build a company, and then take it public at some point. But fast forward 30, 40 years, it happened within a very, very large US publicly listed company.
For sure. And you know what? That's a great point. That's very difficult to disagrry with because we're seeing it across the board amongst all these companies. They have R&D budgets, larger R&D budgets. These companies are also much bigger now. So they can afford to take some more risks. They can afford to, like I said, increase those budgets just to see, what they can just develop in-house versus whether or not they need to actually go out and buy whatever company or innovative team that's developing that new technology. And also you got to think about it, not just from the top down, you also have to think about the tech that's now out there. When you consider, I'm now going to sound like every other talking head out there, but truly when you think about all the innovations in AI, artificial intelligence, I mean, that's solving a lot of problems, especially specifically on the software side within a lot of these companies, so that, a lot of that development can be done much quickly and much even cheaper, despite them increasing their R&D budgets. So, I mean, I'm just saying a lot of things that support what you're saying, but I do still think that because we are living in this more globalized world, that there's always going to be incredibly smart entrepreneurial people that will see a problem and be able to, build a business out of that. Or even within some of these bigger companies, despite them being more focused on hey, let's develop this, or hey, here's a couple million to do some more due diligence or figure out this thing. There's still going to be somebody that's going to be pissed off that their manager didn't take them seriously, didn't see the value in what they developed, go off on their own and build the next AWS. So I don't know. I'm one of those that I don't want to paint with a broad brush, but I do see your point, but I do still think that it's not going to kill the entrepreneurial spirit just because it might be happening more inside some of these bigger companies. I just think that there's just so much out there that it's hard to paint with a broad brush. I guess that's my main point.
Bobby, it's a spectrum.
Sure.
It's not 0 or 1. It's somewhere in between. And that someone in between in my opinion, have been changing and rotating from somewhere, let's say from 0.1 to 0.4 or 0.6. So it's a sliding scale, it moves. It's not fixed. And it could change. I'm talking here more about the trends, but they're not absolute. Of course, there will be brilliant entrepreneurs or engineers or marketers or salespeople who choose to build something on their own. Of course, there will be. Again, I'm not talking, Bobby, there will be no more microcap created because everybody will stay at the big company and never quit. Like, no. We're talking about trends and observations.
Sure.
And remember where I started. We're talking about that. Really, what I'm trying to do in our conversation is explain my logic for that 3 or 4 sentences on stage back in Vegas to explain why I think the historical data is less relevant today because of the underlying changes. And that second change, what I call disruption from the top instead of the bottom, is one of those 2 changes. Mm-hmm. And by the way, it's interesting that you brought AI, because this is, in my opinion, a fascinating example. Think about which companies created search engines when internet was invented. Microsoft missed the boat. There were several competing search engines. Eventually, Google emerged as the ultimate winner. Some people say that AI is incredibly big technological development. Probably it is. I'm not trying to opine there. There are people who are a lot smarter about technology than I am, because actually do technology instead of stock picking. But if you look at the industry structure, who right now is the head of everybody else on AI? There are few players. One of them is OpenAI, which, interestingly enough, have a big investment from Microsoft, a big investment in Microsoft. So Microsoft has not missed the boat this time. Google is building Gemini. They have not missed the boat big time. It's another huge company. No position either in Microsoft or Google. And Meta, as I mentioned already probably twice, still no position. Nothing changed for the last 15 minutes. Again, they are doing a lot in the AI space. That shows me that those big companies, they have not become as complacent as someone in their position 30, 40, 50 years ago. They are looking for the next big thing and trying to capture that, as opposed to, that's not what we do. We're not doing AI. We are doing searches, or we are doing social media. And someone else captures that. Like, no, they are active participants in that technological shift. That's another data point confirming that those mega companies are a lot more innovative today than they used to.
For sure. You know what this also is making me think of, your hypothesis in general. And this is something that, I talk about a lot with, a lot of microcap investing practitioners, is just the lack of a visible, pardon the pun here, but monster winner. That's truly visible. Like, you think of a monster, right? Obviously Expel is probably the most recent, issues recently, but like there's been some winners, no question, but there hasn't been that like truly visible, huge, sustained winner that, other than maybe a couple of those examples, that I think people have been able to point to, and I think that, I don't know, what do you think about that? And by the way, no position in either, but I'm just curious to your thoughts there.
I'm thinking the lack or scarcity, let's say scarcity,
yeah,
of really big, what you're describing as a monster, right? And I assume that you're not referring to the monster stock or the company. You are meaning more in a generic term.
Oh, both. I mean,
both. Okay,
both. Yeah.
Okay, perfect. So
I said, pardon the pun.
Sorry, missed the joke. Sorry.
No, you're good.
I was listening very intently, but I missed the joke.
Sorry, we're on our A+ games right now. We're on a whole nother level. Yes, I got it.
Exactly. So I this is what I think. In order for a company, whether private or public, doesn't matter, to be that monster winner in terms of value creation, most generally, they would be coming from an industry or a place which is relatively young, relatively new, and going through a period of rapid growth. Of course, there are exceptions, don't get me wrong, but it can be innovation, either it can be new market, or it can be new business model in existing market. But the company must, if the company creates such a tremendous value that people call it monster, most likely they increased revenue a lot, they increased profitability a lot, and they have not done much dilution, whether private or public. Those are components of value creation. And in order to get there, you generally need to come up with something which is disruptive. And if, based on the observations over the last several years, we don't see that many disruptive things or monsters in the public markets, it makes me think that it's another indirect circumstantial evidence confirming that, yes, most of the disruptive innovation shifted from public microcap, small cap space to private markets or inside large caps.
Yeah. No, it does kind of prove the point a little bit further. Because that was something that I was thinking about when we were talking about AI, is that, like, okay, it seems obvious that some of these bigger companies are going to say, okay, here's the next trend coming. We need to make sure we're ahead of it and not miss the boat like a Microsoft did with search back in the 90s. Okay, we're going to do a significant investment in OpenAI because we see AI as the next thing. What's, I think, always going to be in existence, though, still in the small micro nano cap space, is that you're going to get some of these companies that are going to come out of nowhere that either have a disruptive business model, are just master operators in an industry that maybe is known for having terrible operators, or just don't know how to run businesses efficiently in order to be profitable. I think that's where the opportunity will still always lie, in the nano and microcap space. I mean, I think we're more or less saying the same thing, just differently, but I'm more thinking about it outside of from the top down, where these larger companies are seeing a monster trend coming and allocating capital in order to capture it, versus some of these even, existing, and like using the monster, like energy drink or Expel with, wraps around cars, or, in some of these industries that you are even considered boring industries, boring businesses, where you're going to see, or the opportunity you're going to see in nano micro caps, just disrupting in some way, shape, or form, whether it's a new type of product or just on the operation side. That I think will always be the opportunity set in micro nano cap. If that makes sense?
Yes, I agree with the premise. The question is where those companies are more likely to be found. And I have probably
That's a good question.
2 or 3 observations here. Because remember, we're competing in many ways with private markets. And this is my observations. So, number 1, regions of the US where venture capital and growth equity is just not as developed. That's number 1. Number 2, what I call historical accidents. The company could have stayed private, but for whatever reason, it happened to be public already. Or it became public because of some coincidence. Mm-hmm. That happens. That's number 2. And number 3, international. In many regions across the world, including English-speaking countries, the growth equity is not as developed. It's not as robust. There are just smaller amount of AUM, assets under management, flowing into those strategies. As a result, in many of those countries, companies have to go public early. It's like US in the 90s, right? Or in the 80s, or even 2000s. So those are probably three places that I would guess are good, fruitful ground for hunting.
So I want to move on to another topic within this. And we said we'd get to it later, so I figured we'd get to it now. Is, how does your hypothesis affect fund flows? And I'm talking about both from an institutional allocation perspective, as well as, let's say, when you go out to individual LPs, when you're marketing your fund strategy and saying, and if this hypothesis were to, say, play out.
Bobby, I think that I'm probably not the right person to talk about how capital allocators, endowments, foundations, pension plans, etc., think about those issues, right? Someone like Ted Sidus and his podcast will do a better job than I would.
I'll talk to the Acuitas guys about it.
So
all right, don't forget that part. So then just talking about individual LPs. We'll go there.
Yes. So that's probably also the topic that when I think about fund flows, right? I think more about how funds. What I hear from a number of my fellow investors and a number of peers, they talk about like, oh, fund flows are horrible for microcaps and small caps. That's why this space is not doing well. Do you hear that a lot from different people in your network?
Difficulty raising funds, difficulty, marketing our strategy.
I'm talking about right now. Okay, let's distinguish, right? You are referring more to LP fundraising. Let's skip that.
Okay.
If it's okay with you. So let's focus on the when fund flows where, look, it's related in the sense that, and I'm oversimplifying the system. If a massive pension fund says, we need to have a very big allocation to public microcaps, then those funds will eventually flow to microcaps. Yes, because that's where this sprinkle of money starts. This is where the creek starts. Agreed with that. I don't have enough data. I am not hanging out with capital allocators on a daily basis to know how they think about those things. So my opinions here will likely be useless and likely will be waste of time for anybody who will decide to listen to this podcast and this conversation with you. So I will keep those. What I am thinking more about is when managers and analysts and our peers, Bobby, talk about those things. This is what I don't like about that mindset. First of all, I think it's very somewhat helpless. I don't know what to do. My portfolio is not doing well. Someone is saying funds are not flowing into my space, into my playground. I think it's very disempowering. So that's number one. I don't like that personally for myself. Number two, which is more fundamental as opposed to emotional or framing your thinking, is the following. What an investor defines as a goal of a microcap investor would be different from one person to another. And if you say, my job is to find companies trading at, and making all these numbers up, 10 times earnings, growing 3% or 5%, and I think it should be traded at 12 times earnings. And when the fund flows comes into the microcap land or small cap land, they will be rated from 10 to 12. This is, in my opinion, splitting hairs. And some people good at that and they know how to do it, kudos to them. And they enjoy that. That's not something that I enjoy doing. What I enjoy doing is looking for companies whose business outcomes on a multi-year time frame would be so impressive that fund flows will not matter that much. If you grow revenue 3x over a 5-year period, and you start with a reasonable valuation, this is an assumption here, guess what? Even if no funds flows into microcap land, you will be discovered and your shareholders will be rewarded. Now, if fund also flows, you may be rewarded more handsomely. I agree with that.
Check your modem or router connection and try again.
One of my technology devices talking. I don't know whether they're giving me stock advice, what to buy, or it will be really funny if Alexa starts saying, Artem, Amazon is a great stock pick. By the way, no position in Amazon. So it will be really funny. Or like some Siri.
Or Alexa goes like, Artem, chill out. Don't worry. Small microcaps will still significantly outperform large mega caps.
Yes.
10 years from now. Like, what are you idiots talking about right now? Sorry for anybody who's an hour in and we're saying this.
that will be very funny. By the way, so yes. Or like, Siri, excuse me, what's the population of Bangladesh? And Siri says like, Siri says, I think Apple is a great buy right now. It's doing a big buyback and cash flow yield is attractive. By the way, no position on Apple either. So that will be very funny. Well, let's see, maybe we'll get there. So going back to fund flows, I think this is what I enjoy doing in microcaps. I love finding, and this is what you and I spoke about first time when I was on your pod several years ago. I think it was 2021. This is what I enjoy doing. This is what I like spending my time. And that's what, I just like spending time in my life that way. So, and in that case, do fund flows matter? Of course they do. But I think the company can still create substantial shareholder value if they succeed on the business outcomes, on the business metrics. And that's how I frame it for myself. So that tailwind from fund flows, if it happens, fantastic. If it doesn't, I will still be finding those companies. We'll still be working on finding those companies would be the right way to say that.
So I think we've really covered this hypothesis pretty in depth, or at least as in depth as I can. Hopefully it was deeper than I am imagining that this came up in my mind. But yeah, sorry.
So one last thing. Remember when you and I spoke about like, okay, so there will be still entrepreneurial people who will be building companies, who will be doing big things, and they will be value created. Where do we find those, right? So I remember I gave you like 3 categories. One, geographic, in the like lack of access to VC growth equity, number 1. Accidental public companies, number 2. International, number 3. This is number 4. And by the way, I use the term. I come up with that term. I believe I've never read it anyway. So maybe I should trademark it, Bobby. Right?
Wait, which term? I want to hear.
I will tell you right now. And actually mentioned that on that panel in Las Vegas as well. Reverse microcaps.
Reverse microcaps. Okay.
Yes. So this is what I mean by reverse microcap. So imagine a typical microcap. You start a small business, you build some momentum, you got some revenue, maybe you got profitable, maybe not. Then you go public as a small company. Your microcap, let's say 50 million, 50. You grow revenue, you grow profits, multiple market recognizes that, you become 100 million market cap company. Then over time, you keep climbing, and if you execute, and you become $500 million company or $1 billion company, right? That's a microcap success story. What I mean by reverse, so they started public small in terms of market cap, and then they've grown. What is reverse microcaps? You started as a $2 billion company, and now you're a microcap with 200 million market cap.
Are you talking about fallen angels? Okay.
Look, I don't like fallen angels because to me, fallen angels generally, the connotation that I have in my mind when I hear fallen angel is this. We used to make $100 million of revenue, numbers are all hypothetical, and now we're making 20. That's a bad business, that's a multi-nice skill, unless there is some massive change happening. So that's what I call fallen angels. So you are looking for almost cigar butts. When I talk about reverse microcaps, what I mean is this. If you take financials of reverse microcap, you're like, oh, revenue grown over the last 5 years nicely. Maybe they got to profitability. Maybe profitability is growing if they're already profitable. You can say, this is great business achievements. This is well done. Like, kudos to you guys. Then you pull out the stock price and you see that the share price is down 80 or 90%. So there is a clear mismatch between business performance and stock price action. Why is that? Because most likely the company went public in 2021, at when we say we as kind of collective markets, collective human beings. Some of us probably had different opinions, but I'm talking about general market.
Sure. Just yeah.
What was valuing anything that was very futuristic? Remember the phrase "the future is here" and how COVID accelerated digital adoption and everything, all those trends, and a number of companies who were beneficiaries of those things went public at incredibly high valuation because people were willing to price them 3 years out at some high growth rates. Guess what? Growth did not come through at the same extent. It came through, but a lot less growth. And as a result, market punished those companies. But many of those companies are actually great companies. I'm not saying all of them. I'm saying some of them, and this is where job of fundamental analyst comes in. Go find them, analyze them, and make your picks. But many of them were actually very innovative. They were private, then they captured the opportunity to go public. And now we have this big choice on our menu. This is what I call reverse microcaps. And this is the difference in my mind from fallen engines.
I'd say that's probably been one of the biggest hunting grounds amongst, some of our close colleagues and friends. That's been probably their primary hunting ground right now, is whether you call fallen angel, reverse microcaps. There's quite a few of these companies that were in that anywhere between 1 to 5 or $1 to $10 billion range in 2020, 2021 that are now hanging out in the sub 250 range, right?
Yeah, no, 100%. Earlier today, I had a Zoom meeting with the management team of a very interesting company that falls exactly into that. It went public at several billion valuation. Now this valuation is substantial. Numbers are from memory, so I can be off. And by the way, I will not mention their name, so even if I'm off, you probably will never find out that I'm off. But I think they went public at 3.5 billion valuation, if I'm not mistaken.
Okay.
And now probably it's less than $500 million, maybe even less than 250. And by the way, when you look at what they do, you talk to management, you have a feeling this is an innovative company that are creating consumer surplus and doing something valuable. Will they build a very big business? Will they be very successful? I don't know. It was only one meeting with them. I was prepared somewhat to the meeting, but I'm not an expert whatsoever. But that's exactly the type of opportunity. 2021, massive valuation. 2024, a lot less. And by the way, the business is better today than it used to be. It was just horribly overvalued. And by the way, Bobby, I think this is also a business opportunity for you and Planet MicroCap Conference. Many of those reverse microcaps are not attending your conference yet.
Yeah. Oh, we got some things cooking for 2025. Artem, the more we talk about this, I don't think that your opinion's that controversial.
Well, I
don't think it's that controversial.
When I got on stage.
It sounded way more controversial when we were on stage. Now I'm thinking to myself, I don't know how controversial it is, but it's interesting. But I still find it fascinating. But
Bobby, now you're called convert.
Oh, now
I converted you from your prior view to something different. And by the way, again, we'll find out over the next several years whether this hypothesis
I sent you
a Zoom.
I already sent you a Zoom invite for 2020. What did we say?
2034, June 12th. I hope. Do you
think that's gonna be a big enough data set though? Should we make it to 2044?
Look, let's make it recurring. Make your calendar invite recurring every 10 years.
Every 10 years.
Do a podcast on this topic.
Hey, who knows? By then we might not be doing podcasts anymore. It might be a whole new
It's going to be virtual reality podcast.
Yeah, it's just like in real time. People are like, "Oh, we now know that they're about to do a recording." Like we're gonna.
So there was this very interesting, cool company. I don't know whether they're still around anymore. I need to check. But they had this beaming technology where they would. So imagine you invited some super famous investor to attend Planet MicroCap, and to do the keynote speech. And that person says, "Bobby, I'm sorry, my private jet just ran out of fuel, so I can."
Like a holographic exactly. Tech for even for somebody that has passed away, like you see all these
Yes.
different art. Okay, you're thinking,
Yes.
oh, okay.
Yeah. So, but that one I'm talking about, it's like for live people. It will be a studio.
We should
A
do that for
person will go into that studio, let's say in New York, and then they will beam this hologram on stage in Las Vegas, where you held Planet MicroCap conference. And that person, it's like pretty cool experience. I've watched some, their demos, their videos. It's pretty cool. I don't know how well they're doing right now, and I will be not mentioning the name, but the company. But technology itself was, in my opinion, quite fascinating.
I'm open to it. Hey, listen, man, we're an innovative small company ourselves, baby. Like we're open.
It will, as far as I remember, like buying that kind of equipment for your own home or your own office or studio, it was more than $100,000. So it's like not cheap. You need to be in business. You cannot just
we'll wait. So we'll wait 5 years.
We may need to wait when the price point comes down, because otherwise it will be cool. You and I can talk, not just like FaceTime or Zoom. We're like, I'll beam myself to you in LA, or beam yourself to me in the Bay Area.
In my brain, I'm already thinking like, all right, how much is my AV cost going to go up now for Vegas? Like, oh, we have to have a new operator, that has to be trained in that. It's going to cost you another $200 an hour. Anyway, Artem, we covered a lot today. This was so much fun. Definitely have you back on to talk more about, maybe if you come up with another controversial idea that's actually controversial. No, I'm just kidding. But this was a lot of fun. Where can people go and find more information on you, get in contact with you, the whole bit?
Well, I have a Twitter account, but I think I tweeted only once in my entire life.
Yes.
So that's probably not I still check it sometimes, the private messages, but not very often. LinkedIn is a good place to get in touch if anybody wants especially if anybody knows researchers or seen academic papers on this topic. I'd love to learn about them. Like on what's happening, those things that Bobby and I discussed. Caro-Kann Capital also has a website. Just Google Caro-Kann Capital. It will come up. That's and LinkedIn is always good.
Beautiful. All right, Artem, thank you so much for joining me. Always do appreciate it. Good luck, stay safe, and I will see you hopefully soon.
Sounds good. Thank you, Bobby.